Happy Friday, the 20th of February. My name is Jessica Amir, a market strategist here with Moomoo. It's great to have your company as always. Well, we all saw what Trump did to Venezuela this year, and now the US has deployed forces around Iran. And it's lighting up commodity screens, isn't it? Given 20% of the world's energy does pass through that Strait of Hormuz. And now some traders are expecting prices of commodities to surge if the strait is blocked. We all know the US military have got naval ships and there's fighter jets surrounding Iran, given that Trump is now giving Iran 10 days to make a nuclear deal. So the market is really starting to price that in worst case probable scenarios. This is exactly why commodity prices are continuing to surge. So crude oil prices in early Asian trade this morning up 2.4%. Natural gas, the standout, up 7.4%. And commodities, of course, that Iran produces are all gaining further bullish legs. Let's think about copper. Copper is high, and so too is aluminium. And of course, the nation produces both of those. As for stocks on the move overnight, the standout is obviously defense stocks. The US Aerospace and Defense ETF, ITA, that's back at record all-time highs. It's now up 13% this year. And expectations are, if the US does strike, you need to watch the volatility index, the VIX. It's already back at 20. So what happens if the US strikes Iran? Well, you probably will be expecting this to go up like a red-hot rocket up vertical. So if that happens, the US strikes, then you would be expecting a broad sell-off. Indeed, in tech or anything that's kind of got a lot of froth in it. So the US major indices, we do know the S&P 500 and the NASDAQ 100, they've already lost luster. We've spoken a lot about this of late. And thinking about the NASDAQ 100, as we stand right now, the NASDAQ 100 is down 5.1% from its high. Guess what? The US software ETF, that's still pretty stinky. It's very stinky. Meanwhile, what is not stinky and what is charging like a bull in a china shop is Australia's share market, punching to record all-time highs. Hallelujah. The Aussie share market is continuing to push up and will probably keep on doing so this year, obviously because commodity demand is on a one-way street, and we all know what's happening with commodity supply. Well, it's pretty thin, pretty thin. So we've spoken a lot about Aussie Resources trading at their highest levels in history, and this is, of course, on the back of better than expected earnings growth, and this is a trend that I believe will continue. Let's just quickly round out other markets now, touching on Asian standouts. South Korea's market continues to lead the world. It hit a brand new record all-time high yesterday. It's now up 35% this year. So where to from here? For you, ladies and gents, where do you put your money? Well, here is an essential guide to picking a growth stock. No matter what's going on in the market, here are a couple key steps to follow. Let's break it down to 6. Step number 1. So consider what's happening at an economic level and an industry level. We call this macroeconomic and microeconomics. Now, these two pillars influence where funds go. And as I always say, where funds go, investment flows. And this ultimately dictates the sectors and stocks that'll do well and will probably continue to do well. So the question is, when it comes to the economy, what's happening at a macroeconomic level? Well, we all know the US Central Bank has been cutting interest rates, while Australia's central bank is starting to rise. Now, this means the US dollar can continue to fall while the Aussie dollar can continue to rise. This dynamic clearly benefits commodities and tech stocks, specifically US tech stocks, because their goods effectively look cheaper. Now, the second component of step 1 is looking at the microeconomics. So think about the industries. So we know we're in the middle of obviously the 4th industrial revolution. We've spoken a lot about that $3.5 trillion AI build out that's needed for the next 5 years. So it's a freight train of stimulus. You need to think about the sectors and stocks that can benefit from this. Obviously, the rise in demand for chips, data centers, energy to keep the lights and power on 24/7. And of course, the commodities to build everything out. That is critical. So then step 2, when it comes to picking growth stocks and sectors, is consider the sectors that are specifically going to benefit from the macro and the microeconomic climate. Obviously, that's right now probably going to be commodities and tech and energy. Now, after you've done that, you move to step 3 of stock picking, confirm earnings growth and expectations. Remember, as I always say, earnings growth drives share price growth. And companies who upgrade their own earnings, as in they're expecting greater earnings than they previously thought, well, they see greater share price growth too. But then companies who also deliver better than expected earnings, well, guess what? Their shares go alley-oop and continue to push up. So these are basically the trends that you need to watch. So the question you might be asking yourself is, shut up, Jess, just tell me where the most earnings growth is going to come from. Well, we've been speaking a lot about this, but we're just going to give you what you need to know. So Australia's materials sector is expected to see 34% earnings growth this year. What about US tech? Well, the US tech sector, specifically thinking about the NASDAQ 100 companies, they're looking at 20% earnings growth. And I've also spoken a lot about US memory companies, SanDisk, Micron. So getting very specific, speaking about tech, we do know Micron and SanDisk are expecting 100% plus earnings growth this year. So you've got those things in your favor you need to consider. Step number 4, when it comes to furthering out of what you need to pick, is you may want to pick ETFs that track those, invest in them for a set and forget investment, or you trade them, as in you buy and you sell them. So for example, Australian Resources, there's many investments to look at, many ETFs. One of those might be OZR. When it comes to tech stocks in the US, those that track the NASDAQ 100, you could look at the QQQ. This is the most traded tech ETF in the world. And of course, when it comes to stocks, there's plenty to look at as well. So step number 5 is to think about the key stocks, the standout stocks that you want to add to your investment portfolio that are expected to see the most earnings ahead. Now, you can do that using Moomoo's platform. Just look under estimates under the company section and then click on financial estimates. So you can see earnings and revenue estimates. And if a company has been delivering better than expected earnings, you can see all of that at a very quick glance. So for example, think about SanDisk, the NASDAQ 100's best performing stock this year. You can see at a very quick glance why SanDisk is that. Why is it the best performing stock in the NASDAQ 100? Well, it's because SanDisk's revenue and earnings are rising and they're expected to continue to rise. Look at this. So as we can see, a revenue hit 4.6 billion. Well, that's the expectation rather for what it's going to hit next quarter. And it's just handed down $2.7 billion of revenue last quarter. So the trend is your friend. And as we can see from this very quick glance as well, this company has a strong history of delivering better than expected earnings. So earnings are expected to grow and they have a history of delivering the goods. Step 6 is a little bit more complex. You don't have to do this, but this is perhaps for the more advanced trader or investor. And step 6 is to look at charts and use technical indicators to see if they validate your decision to buy or hold, or maybe even sell the stock or ETF. So let's just look at Micron, for example. Now, I love using the technical indicator MACD. This is known as the moving average convergence divergence. It basically tells you when momentum is pushing the stock higher and where momentum is changing and essentially bring it down. Now, to add the MACD to your charts on the Moomoo platform, if you're using the app, click on the 4 dots at the bottom of the chart, the 4 squares, and then up comes indicators, and then just click on MACD. But if you are using the desktop version on your PC or MacBook, just click on indicators at the top menu to bring up the side panel, and that's where you'll see MACD. Now, why I really love MACD is it tells you when momentum is in the stock pushing up and when the tide could temporarily change. Now, you can see the MACD was peaking at the level we're highlighting on the screen. When the MACD was peaking, look at that, you saw Micron shares hitting a record all-time high. But when the MACD line started to get a bit shaky and you saw one of those MACD lines fall under the other, this was very symbolic and it meant momentum was changing. Simply, some on Wall Street were selling or taking profits, and that is exactly why Micron shares fell 18% from that level. But selling has slowed, and it looks like the MACD lines are indicating they could cross again, and that could continue to benefit this stock and move it up to the upside. Now, to summarize, what are the 6 steps to picking a growth stock or a potential winning stock? Well, first of all, you need to look at the macro factors, the industry backdrop, identify sectors benefiting, and confirm earnings growth, and then choose ETFs or standout stocks that you like, and you can validate the timing of your buy or sell by looking at technical indicators. Now let's go to investments, 3 investments to add to your watch list. Let's kick off with OZR, the Aussie Resources ETF. Now the market loves Aussie Resources, not only because commodity demand is expected to exceed supply, pushing up prices and earnings growth, thus the price of commodity stocks, but we do know the Magnificent Seven are expected to spend $76.1 billion on AI infrastructure this year. This clearly is going to support commodity demand. And if you look at Moomoo's platform, you can see money is continuing to flow into this very ETF. And that has been the case by looking at the money flow or money flows. You can see it on the app. You can see that's been the case since last August. I don't think money flows are going to slow down into this ETF. So that is why you need to be watching ETFs that track the Aussie resources sector, not just for that reason, but for the other reasons we've touched on earlier today. Stock number 2 to add to your investment watch list is Rio Tinto, the biggest resources company or second biggest in the world, just behind BHP. Now, Rio Tinto released their results after the market closed yesterday. We saw overall pretty good stuff, didn't we? So earnings above expectations, the market loves that. Sales up 7.4%, and that beat expectations. Remember what we were saying earlier, everyone loves it when an earnings result is better than expected. So sales hit 57.6 billion. Underlying earnings, though, that wasn't as great for the full year. It was actually a bit lower than expected. So the market wanted a little bit more hot juice, hot sauce. But similarly, let's think about BHP and Rio Tinto. We all know that they are focused on the future commodity, that's going to be the key driver of revenue growth. So we do know that they are both heavy in iron ore, but they're very now focused on the commodity of the future, copper. So Rio Tinto said this in their results. BHP has also said that. But let's just think about Rio Tinto. Let's think about what else they are going into and doubling down on. We know that Rio Tinto is one of the biggest diversified miners in the world that is going into lithium as well. But we'll touch on that in a sec. But let's just go to how they're doubling down copper. They're actually increasing their copper mining operations in Mongolia. 85% of the miners' exploration budget is now dedicated to copper. So that's telling you something. So copper is playing a huge revenue driver in offsetting what they're seeing in iron ore. As for lithium, I just touched on that. So Rio Tinto is increasing their stake in Canada's lithium project, Nemaska Lithium. They've now taken their holding to 54%. And the company also plans to lift output to a compound annual growth rate of 3% by 2030. It doesn't seem like much, but the narrative is bullish. They're doubling down on copper, they're doubling down on lithium. Now, Rio Tinto shares, they've been doing well so far this year. They're up 15%, 38% in the past 12 months. And on the Moomoo platform, the fact that it's got a buy rating among the average analysts out there, from the 14 analysts who cover it, it basically suggests that more upside is ahead over the next 12 months. We also saw buy ratings reiterated recently, as much as yesterday. Buy calls being reiterated by Barclays, JP Morgan. Last but definitely not least, let's change it up to a market stalwart, I guess you could say. The world's biggest retailer, and that is, of course, Walmart. They released their earnings results last night. A strong quarter driven by higher sales, because middle class Americans are turning to Walmart amid the, I guess you could say, cost of living crisis. Same store sales, that's a tongue twister for me. It might not be for you. Same store US sales rose about 5% in the quarter. Digital sales, though, doing really well, up by 27%. This basically shows, of course, people want to sit in their pajamas while shopping. I do, you do too. So Walmart's yearly revenue hit 713 billion US dollars. Walmart, this number also suggests Walmart is no longer the leading retailer by revenue metric. We have now seen the title go to Amazon. So that is something for you to consider. But back to Walmart, despite the stronger result, their shares did fall in after hours trade, because traders don't really like when a company says, hey, they're expecting softer things ahead. So they are expecting earnings per share for the next quarter to be between 63 and 65 cents. And that's below what the market expected of 68 cents. That basically tells you there's a slowing trend here. For fiscal year sales, growth is only expected of 3.5%. So it's not very lustrous. The market was previously expecting 4.5 to 5% growth. Nevertheless, if you have a look at if I can go again, if you have a look at Moomoo's platform, Walmart is rated as a strong buy among the average analyst, and it was reiterated as a buy yesterday by JP Morgan and DZ Bank. Whoever knows DZ Bank, I don't. Anyway, that's enough from me. Thank you so much for following me. Today's my last day at Moomoo. I'm actually taking some time out to focus on my health and recovery. But I wish you all the very best with your trading and investing. Remember, there is always a bull market somewhere.